everyone. My guest today is Lead Analyst Logan Mohtashami to talk about housing inventory and housing demand. Logan, welcome back to the podcast.
It is wonderful to be here. What a crazy week this has been. Fed week, jobs week, inflation week, and Fed week. And, we're sitting here today. The 10-year yield last time I checked was at 4.14%, but mortgage rates went down just a little bit. It's just been crazy pricing on the mortgage-backed security side. So sometimes over time, this works itself out, but a lot of action with a very minimal move with the 10-year yield. But I just laughed today because when I woke up and I saw the headlines, it said Neil Kashkari said, I don't know. We might not be very far from neutral. There might not be many rate cuts left. And everybody looks at me because that's what we talked about. Whenever we get down to this level, the Fed starts talking a little bit hawkish because the real truth is almost all the rate cuts are somewhat priced in. If you get to 4% on the 10-year, like neutral policy is already priced in. This is why I say it's like really hard to get below 6% rates, especially, I can't even forecast below 5.75. And that's assuming that the spreads improve. But just on cue, he comes out and says, well, neutral policy might be not that far away. However, he did discuss about, the dynamics that in the past, when the labor market breaks, it breaks. Like right. Whatever was driving the cycle, whatever overinvestment was in here, it tends to break out. And you get, layoffs into that because consumption starts to fall down. So on one hand, he said, well, neutral policy is not that far away. But on the other hand, it says, well, we're mindful of this factor. I always say that, all I'm doing is showing charts of manufacturing jobs being lost since 2022, construction workers being lost. And I'm like, if you were really serious, you'd get to neutral policy faster and sit there. So it really depends on how fast they want to get to neutral policy, which is different than me. I'm like, I would not have hiked rates above 4%. I would have already been in neutral policy, and then we take it from there. Of course, this is pre-tariffs. This is 2022. But even with the Fed's inflation outlook, they have 3.1% inflation this year, and then it slowly moves lower over time. So it is what it is, but we're here, and we take it one day at a time.
I think you and I were talking before the show, and we were talking about what neutral policy means. Because to me, I'm like, as a layperson, I'm like, what does that mean? Is that good or is that bad? And I thought it was sort of like a pathway to lower rates, like neutral, and then you go to accommodative. And you're like, they could literally stay in neutral and just stay there.
Yeah, to me, the market always looks out to where the dot. By the way, the Federal Reserve should kill the dot plots. If we need to hire a bunch of assassins and get the dot plot gone, because that thing has just been a mess in terms of forward guidance. But in any case, the market's already anticipated, people could debate what the final number is, but 3 to 3.5% Fed funds rate. So we're not that far off from some people's neutral policy. But for the 10-year yield to go really below 4%, neutral policy is not going to do it. So this is why we created the Hodor line. We're like, getting under 380, man, you better have some really, recessionary data lines to have the bond market. And that's what happened last year. Last year, the 10-year yield got to 3.63. And I was like, this is, you and I had that talk last year around this time, and you're like, can mortgage rates go low? I said, how can it go lower? It's just, this is already pricing in a recession. So it's just hard to get to that next stage lower. But right on cue, whenever we get down to 4% or 6% mortgage, the Fed starts to but it is what it is. This is just how monetary policy works. They work with forward guidance. So it really depends on the economy, labor market, inflation expectations, right? 65 to 75% of where the 10-year yield and 30-year mortgage rate is still Fed policy.
So as always, you feel like the only way we can go lower is related to jobs. It's all about the labor market. What's the level?
So, to me, it's the same premise as 2022. Jobless claims have to break. Jobless claims is the last line of defense. We're not a neutral policy because jobless claims are still low. And this is all the evidence I need that we literally have very little job growth, and they don't care. The fact that Jerome Powell said zero job growth of 50,000 is completely fine. They're basically telling you what I've been saying since end of 2022. They need the labor market to break. Beth Hammock, I'm pretty sure, probably didn't even want to cut rates out there, So it is interesting because Myron came out today, gave his little take. I'm starting to think, what if they wanted him to be the Fed chair? Like, he'll do whatever Trump wants. So if you want loyalty, Waller's probably not the person because, he's a Fed guy. Bessent doesn't want the job. Hassett, I don't know if the market will ever take him seriously. Myron, of course, the markets won't take him seriously, but he'll do whatever Trump tells him to do. So it'll be interesting going out, whenever they announce the next Fed or shadow Fed president, or even the next Fed president. But well, that story's still in the early stages.
Still in the early stages. Okay, we have other things going on. Hard to believe because the Fed has taken up so much oxygen out of the room this week. What else do you want to talk about?
Let's talk about Redfin's greatest seller versus buyer inventory data line in the history of America. I've had a lot of fun with this. I understood what Redfin was trying to say with that data line. But every doomer in America, which every doomer is mostly anti-central bank people, for all of you that are watching on YouTube, hello, I love you all, but y'all, man, the afterlife is calling for you all, and it's down there, not up there. In any case, what I disagreed with how Redfin phrased that, and whoever was the marketing director of that, kudos, because they got every useless YouTube account sharing that thing.
But tell us what you're talking about. Like what?
So Redfin created a chart that said this was the biggest gap between buyers and sellers in terms of inventory ever. And people took that as home prices were about to crash. And what happened was they weren't really implying that, but when you go out there into the lands of the Huns and the Visselocks and all them, it just that's just how it operates. So what occurred was it generated a lot of attention, and literally since day one, since that chart came out there, median prices on the Redfin data on the weeklies have been up year over year. And then what occurred is that this is the best part of it. This has been actually one of the most fun things to watch in the last 14 years for me. What a bunch of amateurs did is that they kept on saying the second half of 2025 would have this big, huge price crash, just like Redfin showed in 2022. What has occurred is since June in that time frame, not only has prices not declined like they thought, the gap is now still rising versus 2024 data, and it's just to watch some of these grown men just like, what's this? How's this happening? They feel like they were betrayed, but they just don't read. And this is what happens when people who don't read look at a chart and they go, wow, look, it's 2008. And then Redfin goes on and says, it's the highest cancellation rates in history. Literally, the data line has not gone anywhere in 3 years. And they sucker everyone into this because they don't realize that every single year they revise the previous year lower. So the next year is always the highest ever. And it doesn't go anywhere. And it's just like, I feel like so many people just thought, and Redfin wasn't saying that. Redfin just says toward the end of the year, pricing could be down just a little bit, which I would take because that helps affordability. But how this country works is doom porn. Any chart that could say it's housing 2008, they'll take. But this one just blew up in your face, like really bad in a very short amount of time, because now it's like the median sales price is actually growing a little bit more on a year over year basis. So there's a lot of confusion, but Redfin was never saying like literally 2007. What do we always do when we do these Logan live shows? We go 2007 says, hold my beer. Homies, yep. That's what it was. That's not, life didn't start at 2013. But my biggest gripe with that data line is that in 2022, we saw authentic pricing decline. If you look at their chart, not much was happening in that chart. But because the supply and demand equilibrium, and we are all slope of the curve economic people with our data lines, the slope of the curve showed a lot of buyer-seller stress. And that's why it's really rare in the second half to have home prices decline. Usually the median sales price declines, but we actually authentically had home prices decline. Of course, we were running at 18% to start the year, but that actually, that worked, right? Our slope of the curve was very fast. Nothing. You go really Redfin's chart, nothing happened in the second half of the day. And that's my biggest gripe with that data line, because it never captured when we actually did have buyer seller stress. So people took that chart and just abused it, and then they took other stuff and then they abused other things. And who I love, like Redfin's marketing person, A+. You got the job done. You got a bunch of people to read your stuff and completely had no idea what it meant. But that's been really fun to watch, because we're mid-September. We're almost in October. Or Logan's about to do his vampire, werewolf, John Wick, all this stuff coming out there. And it just didn't occur. And now rates went lower. So it's really hard to have that supply and demand equilibrium that we saw in 2022, because 2022 home sales were crashing, waterfall, fastest crash ever, because the forward-looking data were getting bad. I remember, saying, boy, purchase application data looks like it wants to take existing home sales to 4 million. We had just broken under 5 million. That to take that next million lower is a lot, but that's what the forward data was going. Never here. Not one day, not 1 second, not 1 week, not a month, anytime. It was never in the data line. It was false, but it was entertaining. So I do enjoy that. As you can see, the grin is a little bit bigger today, because I see these people go, what's going on? I said, no, you didn't read. You saw a chart and you went straight doom porn 24/7 and you got burned on it. But it's okay, right, because you're never going to read and you're never going to get help. And we don't need to help guys like you, because it doesn't matter, because you wake up every single day like this. Nothing's going to change.
And that was a pretty short rant for you, really. When
it was fun. It is rare to get me like to have this big of a grin, but I mean, just like watching some people just sit there and go, but I thought this was a great, why isn't Redfin's data? Now they're accusing Redfin of like having fake sales price data, whatever. And it's just like, it's just beautiful to watch. Why? There's a group of people in this country that do not read. And they wake up and just the soul and just living in America after 1913 has just been too painful, Wheeler. It is too painful for these people after the Federal Reserve was created.
I said, well, that was a pretty short rant. And then you just went on another rant. So I guess I should have just taken it. Well, let's go. Let's talk about our data, right? So we have great fresh weekly data, HousingWire data. And I think one of the things I wanted to talk about was inventory. So you just talked about it. The thing that you keep emphasizing, where you did earlier in the year, was the fact that we were getting back to a more balanced market, because we finally had some inventory coming online and staying for a while, so that people had choices. That helps with the overall home prices, all of that. Where is inventory right now?
So to me, 2025, the best story for housing is always the inventory growth, because if you want to have a supply and demand equilibrium that's functional, you can't have what you had after 2020. That is not, and I'm not even a low inventory guy. I used to make fun of the low inventory people in the last decade. I said, there's plenty of homes to buy. Yeah, that's not a thing. But this one broke that code. So I have to adjust, even something I don't believe in. When you see it and there's too many people bidding on too few homes, that's not a good thing. So the inventory growth has been a positive. But after May 23rd, things started to change a little bit. I just think that inventory growth was so strong early on, and some sellers just didn't get what they wanted. And then rates started to creep down a little bit lower. So the supply and demand equilibrium switch on May, the new listings data actually peaked. Then in June, mid-June, the supply and demand equilibrium started to stabilize. Then in August, inventory actually fell, which is rare for our data line going back the last few years. It's normal pre-COVID. So now I was thinking that inventory shouldn't have peaked, should actually increase and peak a little bit later. So far, I've been wrong on that. So now that we got the 2 weeks out of the system from a holiday, we get to track this data line and see it. So when this podcast comes out, the tracker article will be out. I can't wait to see what the data line shows. But this year was balance, right? Yeah. This is out of all the years, 2020 to 2025, 2025 is my favorite year, because it is the closest thing to balance you could get, because this is just a home for people to live in. This is not, this is not open door stock or Bitcoin or anything. People make this choice to live in a house for a very long time, and it needs to be stabilized. And the only way to get sellers to play ball is to get inventory up, right? Because these are no holy angels out there. They're here because they are not the Martian Dimes, Sarah Wheeler. They're here to make one of the greatest things I've heard in housing economics is I saw this report that said, oh, home prices are going to fall a lot now because the sellers don't have to pay commission. I was like, oh my God, what bar did you just get out of? These are American home sellers, man. They want all the money they could possibly get. If they don't get the price they want, they just take their homes off the thing. So it's just sellers don't play ball unless you get supply up and days on markets grows. That's why I have a whole days on markets. I just want the days on market, the NAR data, to go back to 30 to 45. We quite didn't have that happen this year. We're still under 30, but it's a much more balanced marketplace. And this is how housing should be, not what happened in 2020, 2021, and the early part of 2022. That was savagely unhealthy. Now it is a very healthy housing market, and I'm very happy about 2025.
You give home sellers a bad time, but like this is the American dream. If the American dream is this is how you build wealth, you better get a really good price, the best price you can get for your home, because you're building wealth with that decision. As
Well,
someone
that
who has
seller then
been
becomes
selling my
that
homes, I'm on the seller's side as long as they're being reasonable.
most sellers are home buyers. So they get it
That's
on the
true.
other side too. So,
That's
an
true.
investor is a whole different ballgame. That's structurally different. I just look at housing economics as the cost of shelter. I don't look at it as an investment. That's my whole thing. Housing is a cost of shelter to your own capacity to own the debt payment, really. It's not an investment. I understand why people look at it as investments for whatever, $55 trillion worth of home house. I get that aspect. But when I look at the economic side, I look at it as shelter first. And when you look at it as shelter first, then all of a sudden the last 80 years start to make more sense, right? It was the anomaly period was 2002 to 2005. That was just leverage credit booms. That was the anomaly period going back 80 years. But now this looks normal, and it's just like, it's good. It's good to have this market. So even though I'm somewhat disappointed inventory didn't grow as much, but the supply and demand is so much better now than it was an early part of COVID.
Okay, what else are you looking for data wise from the tracker this weekend?
Well, to me, it's the price cut percentage didn't have the increase that I thought it should have last week. So I'm waiting to see is inventory really peaked in early August, and are we just doing the natural curve lower? So I'm trying to defer when are we actually having the natural decline in everything, and then when that occurs, we're starting to build up to what's going to happen in 2026 because you use that framework. But also, how does everything act with lower rates? Now, the demand that I've always talked about, having 12 to 14 weeks of positive purchase application data, we're at 7, right? So out of the 7 weeks, 6 were positive. So we need about 6 to 8 more weeks of positive weekly data for it to really kick up. So I'm not looking for much on the existing home sales report coming out next week. But if you could get 12 to 14 weeks of positive weekly purchase application data and positive year over year together, that'd be the first time. And then I'd really like to see how that data works. So I'm trying to see is how early in the curve do we see this demand picked up like we saw last year? Like last year, we had, out of that 18 weeks, 12 were positive, 5 negatives. And then we saw the, home sales start to kick up and then, start to rise. So that's what I'm always looking for in the tracker now that rates are under 6.64 with some duration out there. So it's always the demand curves, the inventory curves, the new listings, price cut percentages, mortgage rates, 10-year yields, everything. It's the whole economic enchilada, and it's slope of the curve economics. We're not here to doom porn anybody. We're here to just make economics as fun as possible, as understandable as you can, so you all can understand what's really going on, because some people were completely led astray, and I can't feel bad for any of you guys.
Well, you know what? I think that's the perfect way to end this podcast. You just don't feel bad for any of them. But would
No, not
encourage.
American bears. All American bears have failed since 1790. Economic cycles come and go, but they have all failed. The graveyard is deep, right? It's deep, and they've got the Russians, the Chinese, the Iranians are all coming down there. They're all going to have a nice time in hell. But since 1790, right? It used to be really tough back in the days, right? But now, I always say, y'all got DoorDash, AI, and everything. Y'all complaining, man. Would not last 10 or 15 minutes at 1745 or 1890 or any of those periods, man. Come on.
Listen, I wouldn't. No, I need my modern conveniences. I love
Yeah.
indoor plumbing. Love it. So, all right, we will end there. Would encourage everyone. We are getting close to our HousingWire Banking Summit. That's going to be October 7th here in Dallas. Logan, you're going to be our keynote. It's going to be amazing. We have a ton of great speakers and sessions lined up, and some really fun ways to interact too and network. So everyone should join us. And Logan, you can pester Logan with your questions in person at that event. So encourage y'all to sign up.
How about those Cowboys? I'm so excited about the Niners. They could be 3-0, and I'm gonna get to see Emmitt Smith soon because we're gonna be on stage. So I'm just so psyched that football season here. It's just wonderful.
You love football as we do. All right, okay, Logan. We'll talk to you again soon. Thank you.